At Know Your Numbers Accounting, we believe in providing free small business education, which is useful, but not nearly as cute as a free small business Dalmatian. Today we'll be talking about the quick ratio. If you haven't watched our video on the current ratio, it'll probably sound like we're gossiping about a friend you don't know very well, so you might want to watch that first, for context. The quick ratio's name makes it sound either speedy or easy, but that's deceiving. This ratio likes to be taken out to a nice candlelit dinner and properly romanced, so don't go making any assumptions. The quick in the quick ratio actually refers to the assets in consideration in the numerator. And if that doesn't make any sense because you haven't had to think about math vocabulary in 20 years, just remember that your small business Dalmatian is a nice dog. Numerator over denominator. Like all liquidity ratios, the quick ratio determines if a business will be able to pay its current liabilities. The difference between the current ratio and the quick ratio is that the quick ratio only considers assets that can easily or quickly be converted into cash. So, the current ratio equals quick assets divided by current liabilities. Quick assets include accounts receivable, marketable securities, and cash. But quick assets don't count things like inventory, which could take time to sell off. Think of it this way. Say you're an old-timey gambling man on a casino steamboat. You arrived with a fedora and a dream. But you're not a good gambler per se, so you end up losing $200. Hey, it's the black and white old days. That's a lot of dough. You have $80 cash and a pocket watch on you, worth maybe $20. You also own a car and some nice pairs of cufflinks back home, worth well over the $100 debt remaining. If I use the current ratio to evaluate your sticky situation, I'd probably say you are fine. Your complete assets cover your gambling debt, no problem. But if I use the quick ratio, all those assets back at home don't count. You need to pay that gambling debt now, and those cufflinks would need to be pawned at a loss to be turned into cash. Will Snake Eyes Charlie be happy when you can only cover half of what you owe? I wrote this as a hypothetical, but now I'm worried for you. This difference in eligible assets means the quick ratio is considered a more conservative calculation of liquidity than the current ratio. So even with a nice romantic candle at dinner, the quick ratio isn't going to kiss before the third date. Lenders and investors tend to look both at the current and quick ratios in order to determine a company's financial health. So business owners should keep track of both and compare them for trends over time. A quick ratio equal to or greater than 1 means your business has enough quick assets to cover its current liabilities. Under 1, and you might just be in trouble with Snake Eyes Charlie. Hopefully your liabilities are slightly lower stakes than a mafia-tied riverboat gambling ring. But if you still want to ensure your company can cover its debts, contact Know Your Numbers Accounting today to accurately calculate your ongoing financial ratios.